What if I told you that the average American can no longer buy a new car without taking out a 7 year loan? Well, that's 84 months of debt just to afford something to drive. And here's the shocking part: stretching out your payments might make your monthly bill look more affordable, but it's actually costing you thousands of dollars more in interest and leaving millions of people trapped in loans where they owe more than the car is actually worth. Now, that's called being upside down. And it's the same kind of trap that homeowners faced during the 2008 housing crash. And today, it's happening with cars. So before you even think about signing a new auto loan, you need to see what's really happening. So just before we take a deep dive, it's imperative you hit that like button and subscribe so that you get notified the minute we produce another game-changing video that affects your money. I promise you'll appreciate it. So buckle up and let's plunge straight in. So first off, as you know, the numbers don't lie. The average price of a new car in America today is right around $50,000. Now, that's the number we used to only associate with luxury sedans and high-end trucks. Now, that's mainstream. And for many households, the only way to get the payment under $700 or $800 a month is to take out a longer loan. A 7 year loan, or in some cases, even 8 years. Now, here's what that actually looks like. So, on a $50,000 car with an 8% interest rate, a 7 year loan will rack up almost $16,000 in interest. And that's about $5,000 more than you'd have to pay on a 5 year loan. But because so many people shop by monthly payment instead of total cost, well, they fall right into the trap that the dealership set for you. And it's not just the loan. Insurance, too, has become another hidden killer. Over the last 5 years, insurance costs have risen nearly 30% nationwide. And in some cities like Detroit, Miami, and New York, monthly insurance bills actually cost more than the monthly payment. Imagine that, paying more for insurance than the loan itself. But that's the new reality. Now let's talk about why those 7 year loans are so very dangerous. And I've got a list, so here goes. First off, depreciation. See, cars are not houses. The moment you drive off the lot, your car loses 10 to 15% of its value instantly. And by year 5, well, most cars lose 50 to 60% of their total value. So that means on a 7 year loan, you'll almost always be upside down. In other words, you owe more than the car is actually worth. Now, if you need to sell, trade in, or if the car gets totaled in an accident, you're stuck with debt that actually outlives the car itself. Second on this list is rollover debt. So if you try to get a new car before your old loan is paid off, well, that remaining debt doesn't vanish. You know that. It just gets rolled into your new loan. And then your debt grows bigger and bigger and bigger. Millions of Americans today are now driving newer cars while still paying for the last one. Third on the list, interest rates. See, during the pandemic, car prices skyrocketed because of shortages. Dealers and lenders quickly adjusted, and what used to be a 3% auto loan has now become 7 to 8%. And that tiny shifts, well, it adds thousands to the life of the loan. So while the loan term got longer, the rates also got higher. And that, as you know, is a double whammy. Fourth on the list, used car prices. Now you might think, fine, I'll just go buy used. But the demand for used cars has pushed prices up too. See, the average used car now costs nearly $30,000. 5 years ago, that would have bought you a brand new base model Honda Civic and still given you some change. So there is no escaping high prices, either new or used. Now, on this list, let's not forget electric vehicles. See, EVs have an even higher average price tag, $58,000. Now, if you add in expensive insurance premiums and higher repair costs when the batteries or the sensors fail, Well, you can begin to see why EV buyers are stretching to 7-year loans. But there's another side effect of these extended loans that doesn't get enough attention. See, they trap households in a cycle of debt that squeezes out every other financial goal. Because when you're locked into a 7-year loan, well, it makes it harder to save for retirement, to pay off your credit cards, or even cover unexpected medical bills. Families are essentially betting their financial future on keeping one car running for a decade. Well, and if that car fails early, they're left with no payments and also no vehicle. Psychologically, though, car loans feel normal. Dealers tend to market it as, look, it's only $650 a month, but think about it. $650 over 84 months is $54,600, and that's way more than the car itself costs. People don't think in terms of total outlay. All they think is in terms of survival every month. And it's the same trick that credit card companies use, and it's a big reason that households feel broke even when they're making a good income. Now, do me a favor, if you're getting value out of this breakdown, smash the like button and hit subscribe, because in the second half of this video, I'm going to show you the strategies that rich people use to avoid these traps and the checklist that you can use before signing your next loan. So stay with me, guys. So the big question is, what can you do to avoid being buried in car debt? Number one, focus on total cost of ownership, not monthly payments. If the dealer asks, what monthly payment do you want? Just walk away. I'll repeat it. If they ask what monthly payment you want, walk away. Always negotiate based on the total price of the car, not the monthly figure that they can stretch. Number two on the list, shorten the loan if possible. See, a 5-year loan is still expensive, but you do save thousands in interest compared to a 7-year loan. Even better, if you can, buy a reliable car that you can keep for 10 years or more. And it may surprise you to know that the average car on the road today is over 12 years old. So long-term ownership is how families win financially. Number three, this is really important. Do not forget the phantom costs. We're talking about gas, insurance, maintenance, registration, even parking. These can easily double your car payment. So if you think you're paying $600 a month, well, you're probably closer to $1,200 a month. So budget accordingly. Number four on the list, consider certified pre-owned vehicles. Now, these can save you 20 to 30% off the new car prices while still providing warranty coverage. But just make sure the warranty hasn't expired and avoid vehicles known for reliability issues. Fifth on the list, if you absolutely need a new car, look at the incentives very closely. Manufacturers sometimes subsidize interest rates like 2.9% offers on select models, but they're usually limited to buyers with excellent credit and shorter loan terms. And finally, if you're in the market for an EV, be very, very cautious. Battery technology is advancing so quickly that today's $60,000 EV, well, it might be worth $25,000 in just a few years. Leasing might actually make more sense for an EV since you're not stuck with the long-term depreciation risk. Now, here's the harsh truth. 7-year loans don't just cost more, they lock you into a lifestyle where you're always behind. The wealthy avoid this trap by either buying cars outright or holding on to them for a decade. They don't let a dealership talk them into financing a depreciating asset for longer than the average mortgage on a house used to be. So here comes the bottom line. Cars have never been more expensive, and 7-year loans might make the payment feel manageable, but they are a financial time bomb. If you can't afford the car on a 5-year loan, well, you can't afford the car, period. So before you head to a dealership, run the numbers, factor in insurance, and please Think long term, because buying a car isn't just about what you drive today, it's about protecting your financial future tomorrow. And if you found this video helpful, hit that like button, subscribe, and check out my other videos where I break down the biggest financial traps and how to avoid them. So now I want to hear from you. Would you ever take a 7-year loan for a car? Drop your answers in the comments below. Have a wonderful day, my fellow financial warriors, and I'll see you guys on the next one.